So the middle indicator, and this is a longer term chart going back, I think, 10 years. The middle chart shows us the percent of stocks that are within 2% of their highs. So obviously with the market not near its high, this indicator is going to be pretty low, and it is. But more importantly, when you're in a decline, a major decline, or should I say important decline, the percent of stocks that are 20% or more below their 52-week highs, which is the bottom panel, that ballooned much higher. It got very big. Now, this is an inverted scale chart just so it can match up, I guess, visually with the price chart. So you can see this thing expanded, fell on the visual here, fell to levels that is commensurate with the end of bear markets in the past. So you can see that starting on the left, 2016, 2018, 2020, obviously in the middle without a line, the end of the 2022 bear market. The smaller line to the right, that's the end of the 2023 correction. And you could see that it paused there temporarily before falling through. But the point here is that this indicator got very low, very oversold yet again. And as another indication that the market maybe has gone too far too fast or was washed out. And if it is washed out, we would hope that the buyers respond. Right now, still an issue whether they've responded or not. Here are a few of our short-term indicators. Clearly, they move a lot faster. The top panel is the S&P 500 and its 3% price envelope. Being below the envelope in a decline is not necessarily oversold, but when it gets that far below, you have to think that it's washed out. A lot of panic set into the market. The second panel, percent of NYSE stocks above their 10-day averages, that was fully oversold back in early April. Climbed during the recovery, which was a positive sign, but since this chart was published, it has fallen back into neutral territory. Next is the 14-day stochastic oscillator, your traditional technical momentum indicator. The good news here is that it set a higher low versus a lower low in price. So that could be a positive. If the market does decide it wants to test that low, the price low, we would hope, and if you're bullish, you hope that this indicator does not set a lower low. So that would be the positive divergence in this particular indicator. And finally, at the bottom is our short-term index, which is a short-term version of buying power. It's calculated on a shorter time scale, shorter moving averages. And this fell to a level of 69, which is low, but not officially oversold based on our history of a bear market can fall to, which is 66 or even 60. But the point here is that 69 was like the new 66. Over the last couple of months, every time it hit that, the market stopped falling. So again, potential short-term oversold indicator.